Welcome to End of Day IFRS Spotlight with OJ Samuel. In this episode, we continue with IAS 12 income taxes, part 2. We've dealt with various items under the part 1 and part 1B on ascertaining items that give rise to IFRS deferred tax. In this part 2, we'll be dealing with guide to deferred tax computation, entries, and presentation. Guide to deferred tax computation, entries, and presentation. So having done the consideration under the previous episode on ascertaining those items upon which deferred tax can arise, now we want to give a guide on how the computation is done. So whether on a spreadsheet or manually, on Excel or any such surface, we need to rule tables in a table of rows and columns. So we're going to need a column for the item, the line item themselves, whether they are property, plant, and equipment, whether they're investment property, whether they're intangible assets, for example, whether they are certain biological assets, whether they're inventories measured under net transferable value, or foreign currency-based cash equivalents, trade receivable, or any non-monetary asset or liability measured in foreign currency. So that is the column for the line items. Then there's a column for the current amount. Current amount is the value of the monetary record of those items in accounting system. A typical balance brought down, carry forward, whatsoever. Those are the current amounts. So there's going to be a column for the current amount for each line item that has been evaluated to be an item upon which deferred tax will arise. So there's going to be a column for current amount. After the column for current amount, there's going to be a column for the tax basis or basis for those items. So the tax basis or basis are the tax carrying amount, right? The tax carrying amount or the tax value in line with the tax law and guidelines for the items under consideration. So a column for the tax basis or tax carrying value, as the case may be. So we have the item, the column for the items, the line items, the class. We have a column for the current amount for each of those line items. Then we have a column for the tax basis or basis. Then we have a column for the difference between the current amount and the tax basis or basis. In the first episode under IAS income taxes, we dealt in detail the meaning of deferred tax and why deferred tax arises. There is a philosophy, there's a principle behind it. So the end of this step is now to compare the current amount of the qualifying item, so to say, and the column for the tax basis or the tax window value. We compare the amount, the difference is entered into the column. So that column is where we put in the difference. It may be taxable difference or deductible difference. When we say taxable difference, recall the items that are being considered may be asset, may be liability. So it is not automatic that items that are assets give rise to taxable temporary difference, or the items that are liability give rise to deductible temporary difference, or the items like last relief carry forward, unabsorbed capital allowance, or tax credits not utilized. It does not mean that they automatically give rise to the deductible. No, it doesn't work that way. So it has to be interpreted in the context of the status of those items as such a reporting date. So for a PP, for example, if the current amount of PP is 15 million and the tax window value is 12 million, the meaning is this: the amount to be deducted in the future in ascertaining taxable profit is 12 million under the tax law or within the tax framework. However, in accounting framework, it is 15 million. The meaning is this: 15 million accounting current amount compared with 12 million tax written down value gives an excess of 3 million that is being carried in accounting system that will be disallowed in the future. So the 15 million current amount less 12 million gives 3 million. That 3 million becomes a taxable temporary difference. Taxable meaning it's going to be disallowed and entity will suffer the tax effect of an increased future income profit. That is the impact. It's going to be disallowed and resulting into a higher amount of taxable profit in the future. Now, let's look at another example. Say trade receivable. A trade receivable has a given an amount, a current amount in the system of 8 million. Right, under the tax framework, what the tax authority assigns for that item, right? Okay, let's say under the accounting system, let's use discrete figure, 10 million. Under the tax system, the tax base for that trade receivable is 15 million. This is the meaning. The meaning is the entity had written down its inventory, had written down its trade receivable to 10 million. 10 million. However, the tax authority disallowed 15 million, disallowed 5 million out of the total of that trade receivable, making it to still assert that the tax base for that trade receivable is 15 million. You notice 15 million tax basis of trade receivable is higher than the 10 million current amount under the accounting framework. This is it. In the future, if this entity is to impair or to write off, right, because there has been an impairment with the tax authority disallowed, that is what is making them carry 15 million in their record or in the record of the tax record, whereas in the accounting record, it is 10 million. The meaning is this: when those trade receivables do go bad, when they become bad debts, ultimately verified and confirmed, a 5 million naira excess differential will be deductible in the future before that future taxable profit will be arrived at. Therefore, in that case, we are seeing an accounting record of 10 million lower than the tax record of 15 million. So the 5 million differential is a deductible temporary difference. Deductible because 15 million future provision of crystallized will be deducted in the system or in the future determination of sale profit as against the 10 million carried in accounting record. So this is going to be a future benefit to that entity. So the 5 million differential is a deductible temporary difference. This is just to clarify, there is no absolute. It's not a case of all assets gives rise to deductible, or all assets gives rise to taxable, or all liability gives rise to, no, it doesn't work that way. It is the meaning, the sense behind the evaluation, that was duly considered in the 2 earlier episodes we held under this end of day spotlight on IAS income taxes. So it's about the reason behind it that determines whether a difference is a taxable difference or whether a difference is a deductible difference. Yes, taxable temporary difference, right? Or a deductible temporary difference, whatsoever. So it is the reason behind it that will inform that. So it is good to know. So on the ruling, the column for the item, column for the current amount, column for the tax basis or terminal value, then column for the difference that may be taxable or deductible. Then we now have a column for the rates, for the tax rates. So that rate, if the rate applicable to that entity in that category, for example, a large company under Nigerian tax law pays income tax as 30%. In that case, the column for the tax rate, income tax, will be 30%. That will be used to multiply that temporary difference, as the case may be. If the entity is a medium-sized company, 20% to be used to multiply that difference. So the 30% or 20% multiplied by the temporary difference will give the deferred tax asset or a deferred tax liability. Where the difference is the taxable temporary difference, it gives us the deferred tax liability. When the difference is a deductible temporary difference, it gives us the deferred tax asset. So that is the summary. The column for the items, be they PPE, capital allowance unabsorbed, loss relief carry forward, just mention them. That is the column for the item, column for the current amount, column for the tax basis or tax return value, the column for the taxable temporary difference or deductible temporary difference, then the column for the income tax rate. Is it 30%? Is it 20%? Then that rate multiplied by that temporary difference will give the deferred tax asset or the deferred tax liability. Further information. What happens to loss carried forward or unabsorbed capital allowance or tax credits not utilized as at the given date? What do we call the carrying amount for these items? These items are not in the accounting system. So the carrying amount for these items are nil, 0, 0, 0. under the carrying amount column, right, for unabsorbed capital allowance, for losses carried forward, and for all other tax credits not yet relieved or enjoyed as a reporting date, the amount of written under the current amount is dash nil because they do not exist under the accounting system. Under the tax basis, or what I just mentioned to be tax down value, but tax basis is a more encompassing name for all category of item under taxes, tax basis. So for the column under tax basis, that is where you enter the amount of capital allowance you've carried forward, or the amount of losses you've carried forward, or the amount of cash credits or reliefs that you are yet to enjoy. That is where the column enters. So you can contrast that under the carrying amount column, it is nil for these items. Under the tax basis column for this item, there is a figure. So you note at all time, the tax basis for this item, of course, automatically will be more than the carrying amount because the carrying amount is new. So giving rise to a deductible temporary difference. This is what we said in the episode 2 or episode 1B, that these items that are not in the accounting system, like unabsorbed capital allowance, losses carried forward, and other tax credits unutilized, always give rise to deferred tax assets. Because the difference between the tax basis and the new kind amount will give you a deductible temporary difference. So that temporary difference multiplied by either 30% or 20%, as the case may be, whether a large or medium-sized company, will give a deferred tax asset. Now let's move on further. What about items that are not CIT items? They are not items that are considered in computing company income tax. Let's say capital gains tax item. When an item is a capital gains tax item, the income tax rate is 10% under Nigerian law. So all other items remain, but under the income rate column, the rate will be 10%, not 30%, not 20%. The rate is 10% because it is associated rate, the rate applicable or substantively applicable for that profit line item concerned. So all of the potential capital gains inherent in any item, potential capital gains, not realized, their potential, that is why they are deferred tax item, potential. So the rate for such item is 10%. What happens to an individual business or a partnership? These are not companies. These are not incorporated as a limited liability to which the 30%, 20% apply. These are individual businesses. For example, what rate? Or whether taxable under the Personal Income Tax Law or Personal Income Tax Act as amended. So the average rate of all of those graduated income rates, 7%, 11%, 15%, 19%, 21%, in that order. The average of all of those rates is 16%. That is the provision of IAS 12 income taxes. So the average rate for individual or partnership that should be used in multiplying any taxable or deductible temporary difference that arises in their reporting is 16%. So in summary, 30% for large company, 20% for medium-sized company, 10% for a taxable difference that is capital or that is of capital gain nature, and 16% for all temporary difference arising from individual or partnership businesses. So the rate multiplied by those temporary differences will give the deferred tax asset or deferred tax liability. That is for the computation. Now, the next step is to compare. If as at a year end, say March 31, 2024, with a certain deferred tax asset, deferred tax liability for each of the line item. We then compare these balances with the opening balances for this item. What were the deferred tax balances? So compare the opening balance and the closing balance. Now, this comparison is done for each line item. But for the presentation, let's go with the netting of the line item. So from your PPE, intangible asset, investment property, inventories, trade payable, your foreign currency denominated payable or receivable, for these are the line item. Let's after netting the deferred tax position, what we have is a net deferred tax liability. We compare it with the net deferred tax position as at the beginning of that period. So if a net deferred tax liability at the end of the period is more than an existing net deferred tax liability as at the beginning. See, this is the situation. Beginning was a net deferred tax liability position. At the end is a net deferred tax liability position. However, the net deferred tax liability position at the end is higher or more than the net deferred tax liability position at the beginning. Therefore, there's an increase in liability. So the net increase is a deferred tax expense. The movement for deferred tax within that period is a deferred tax expense movement. Why? Because the net deferred tax liability position as at the end of the period is more than the opening net deferred tax liability position. Let's flip the coin. When the closing net deferred tax liability position is lower or less than the opening net deferred tax liability position, we have a deferred tax income movement. Why? Because the reduction in the opening net deferred tax liability, the reduced amount at the end of the period. So that reduction in the deferred tax liability, the summation of the reduction, which is the net reduction, is a deferred tax income. Whereas an increase in a net deferred tax liability position will give a deferred tax expense, but a decrease will give a deferred tax income. If it was a net deferred tax asset at start, we compare as I've said earlier. So at start, a net deferred tax asset increasing into the year end is an increase in assets. So such increase in assets is a deferred tax income. The other way around, where there was a net deferred tax asset at start and at end, there's a reduction, there's a reduced net deferred tax asset. That means there's a reduction in assets. That will translate to a net deferred tax expense. What you have as the movement for that period is a deferred tax expense, even though net asset positions are concerned, but in the case of a reduction within such period, that is what is done. Now, it is possible that a net deferred tax asset position may translate into a net deferred tax liability position, meaning from asset into liability. Whenever a net deferred tax asset position translates into a net deferred tax liability position, that is a deferred tax expense because it has swung from a positive or from an asset into a liability. Same thing applies when a net deferred tax liability position translates or swings into a net deferred tax asset position. It means there is an increase in the benefit. So what arises there is the case of deferred tax income. So in summary, asset at start that increases at year end, deferred tax expense. So I'm sorry, liability at start that increases at year end is deferred tax expense. Asset at start, okay, let's take it for liability asset in that way. Liability at start that increases at year end is a deferred tax expense. Liability at start that reduces at year end is a deferred tax income. Asset at start that increases at year end is a deferred tax income. Asset at start that reduces at year end is a deferred tax expense. Liability position that swings into asset position is a deferred tax income. Take note, everything is net that we are considering. Once again, liability position that swings into an asset position is a deferred tax income. And an asset position that swings into a liability position is a deferred tax expense. So that is the movement for deferred tax. We've discussed the item, the carrying amount, the tax base, the temporary difference, taxable or deductible, the relevant rates, 30%, 20%, 10%, 16%, to get the net deferred tax asset or liability, which you then compare with what the position was at start to ascertain the movement, which could be a deferred tax income or a deferred tax expense. Now, what happens to the net deferred tax expense ascertained or the net deferred tax income ascertained? What happens ultimately? So the net deferred tax income or the net deferred tax expense is transferred into income tax expense. So the accounting entry is, if the total movement is a net deferred tax expense, right? If the netting of all the movement is a net deferred tax expense, is a debit to your income tax expense and a credit to your deferred tax account. I repeat, if the netting of the movement is a net deferred tax expense, the entry is a debit to income tax expense and a credit into deferred tax account. A credit will mean that if nothing was in that deferred tax account, for example, it's going to be a deferred tax liability. However, if the netting of the movement gives a net deferred tax income, it's going to be a debit to the deferred tax account and a credit to the income tax expense. That is the entry. The income tax expense itself that we are referred to for the corresponding entry contains two items. This deferred tax movement we've mentioned, whether the net deferred tax income or the net deferred tax expense is there, plus the current tax expense for that period. The company income tax of this world, the tertiary education tax, the Nigerian Police Trust Fund levy, the Information Technology Development levy, for example, and just all those capital gains tax. So your income tax doesn't contain a group of movements which are current tax movements and a netting of movements which is the netting which is deferred tax movement. That is what we have in the income tax expense account. And that income tax expense item will appear in your profit or loss or in your other comprehensive income. Generally, for CIT-related activity, the income tax expense is presented in profit or loss. However, where deferred tax movement arises by virtue of capital gain, right? By virtue of capital gain, it is likely that a revaluation had been done. We're talking about potential capital gain. The capital gain has not materialized, potential capital gain. It's most likely that a revaluation has been done, and the current amount based on revaluation makes it more than the historical cost, right? Than the current cost or the current amount. So it depends. A revaluation may be done that can give rise to a capital gain. A revaluation can be done that will give rise to what corresponds to a balancing charge. So care need to be taken to know a revaluation surplus. Is it a surplus that goes beyond the historical cost? Or is it a surplus that goes above the current amount of an item but below the historical cost? When the revaluation surplus is that which goes above the current amount but below the historical cost, that revaluation surplus is subject to 30% multiplication because it's a balancing charge item, not a capital gain tax item. So the difference associated with that portion of the difference that is above the current amount of a revalued item, but below the acquisition cost or execution cost is a balancing charge, right? Is a differential that will give us a balancing charge with the 30% times that portion of the valuation differential or surplus. But if the valuation surplus is a portion that goes beyond the historical cost, that portion beyond the historical cost is subject to capital gains tax by 10%. To give us a potential deferred tax on the capital gain portion. And 30% will still apply to the other portion above the current amount, but not beyond the historical cost. The point of emphasis is this: any portion of a revaluation surplus that gives us the deferred tax movement is presented in other comprehensive income. If the revaluation surplus is the portion that is beyond the historical cost. Any revaluation surplus that arises by the virtue of being beyond the historical cost gives us the deferred tax for that portion. That portion of the deferred tax, that portion that is 10% times the excess of the valued amount over the historical cost gives a portion of deferred tax that is presented in OCI. That portion of deferred tax is not presented in profit or loss because it's not a company income tax item. It's an item arising on a potential capital gain, and that potential capital gain is a resultant of an excess beyond the historical cost. And as we know, revaluation surplus is presented in OCI. However, the revaluation surplus does not translate to capital gain, but translates to a balancing charge. The associated deferred tax, which will be measured at 30%, is presented also in the OCI. So it's important to note, deferred tax follows the item that triggers the basis or the differential, which is multiplied in arrival at the deferred tax. So that is that on deferred tax computation, deferred tax entry, and presentation in the phase of statement of comprehensive income. We move ahead to statement of financial position. What happens to deferred tax? In the statement of financial position, it is the net position that is presented. Why deferred tax asset, deferred tax liability will arise on different line items, the net position could be either a net deferred tax asset or a net deferred tax liability. So this net position is what is presented in the phase of statement of financial position. So they are not bifurcated. When you do a bifurcation, say this group is for deferred tax asset, this group for deferred tax liability. So let's present some under asset, some under liability. It's not done that way. It is the net position that is presented. So a net deferred tax liability will be presented under liability, and a net deferred tax asset will be presented under asset. That is the presentation in the phase of statement of financial position. Where a current, non-current classification is made, as is done in all other entities apart from financial institutions, where a current, non-current classification is made, all net deferred tax positions are presented either as a non-current asset or as a non-current liability. Where a current, non-current presentation is made, net deferred tax position is presented either under non-current assets or either under non-current liability. But where an order of liquidity method is done, as we do for financial institution, there's no current, there's no non-current ordinarily. So the net deferred tax position is presented according to the ranking of liquidity. It is considered illiquid anyway, or one of the least liquid items, presented close to a PPE, investment property, and the items like that. So that's the presentation. Under the non-current classification, deferred tax is presented as a non-current asset or a non-current liability. Under the order of liquidity method, it is presented just alongside according to its ranking of liquidity in the statement of financial position. What happens to the presentation of deferred tax in a group or in a consolidated statement of financial position? For a group, that will mean that the parents and the subsidiary are subsidiaries. So let's take a simple example. There's a parent and the subsidiary. In the book of the parent, the net deferred tax position may be a net deferred tax liability. Stay with me, I repeat. In the book of the parent, the net deferred tax position may be a net deferred tax liability. In the book of the subsidiary, the net deferred tax position may be a net deferred tax asset. So two things: net deferred tax asset for the subsidiary, net deferred tax liability for the parent. How is it presented? In Nigeria, under the Nigerian tax law, we do not do group tax filing. Therefore, each entity is on its own, and transactions are reflected according to the relationship between that entity and the tax authority. Therefore, for the net deferred tax liability concerning the parent, it is presented under liability in the consolidated statement of financial position. And for the net deferred tax asset concerning the subsidiary, it is presented under the net deferred tax asset of the subsidiary. It is presented under assets. There is no netting. There is no netting. They are presented separately. Net deferred tax liability as the liability under the liability side for the parent, and net deferred tax asset under the asset side. There is no netting. In countries where there is group tax filing, netting is done. Where there is group tax filing, a net line item is presented for this, and in the note, a breakdown is given as to the portion that comes from which company and how the netting is done. However, in countries where group tax filing is not done, like in Nigeria, each line item is presented separately. Parent under non-current liability, for example, subsidiary under non-current asset in the consolidated state of financial position. So that is all for this episode on end of the IFRS Spotlight with OJ Samuel. We've considered, part 2, dealing with guide to deferred tax computation, entries, and presentation. Let's have your thoughts on this topic and other things we've done. Use the chat field and make your comments, ask a question, seek clarification, and also give your input. Please like our channel, subscribe to our channel, share it widely within your network as we keep updating it with latest development in the field of IFRS, IPSAS, integrated reporting, sustainability reporting, and similar framework of financial information structure. Thank you so much once again. See you in another episode. Bye for now.